Do you have units in an equity scheme of HDFC Mutual Fund? If yes, then it's likely that you would have displayed emotions ranging from frustration, apathy, and even anger over the past couple of years. And for good reason, because HDFC's largest equity mutual fund schemes have also been among the poorest performers in 2019 and again in 2020. So now that I have your attention, for the next few minutes, I'd like all of us to put our frustration and anguish aside and replace it with curiosity and awareness. Hi everyone, my name is Shankar Nath, and in this video, we not only help you understand why the equity schemes of HDFC Mutual Fund are underperforming, but also try to decode the investing style of HDFC Mutual Funds which can help us become better investors. A great place to start is by comparing two funds from the same fund category. For this, we shall look inside the large cap category. Let's pick the AXIS Bluechip Fund as Exhibit A and the HDFC Top 100 Fund as Exhibit B. At the time of creating this video, AXIS Bluechip was ranked number 1 on ETMONEY and HDFC Top 100 Fund was ranked 31st. Also, in terms of performance, we can see that there's quite a big gap between these two funds. Now, to be a good investor, it's important to also understand why there is a big difference between these two funds. After all, both are large cap funds and both only have a universe of 100 companies to choose from. For this understanding, we need to look at the top 25 holdings of both these funds. The most striking difference between these two funds has to be the proportion of public sector enterprises in each portfolio. The AXIS Bluechip Fund has a grand total of 0 PSUs, while HDFC Top 100 has 8 PSUs in their top 25 companies. 8 PSUs out of 25 is quite unique, which clearly indicates that the HDFC Top 100 fund management team is following a very different strategy of stock picking as compared to its peers in the large cap category. And there is more evidence. For example, when we look at the PE ratio or the price to earnings ratio of these funds, we find that over 90% of AXIS Bluechip holdings have a PE ratio of over 20. On the other hand, the HDFC Top 100 stocks have a more subdued PE multiple, with less than half of the top 25 holdings breaching the 20 mark. In addition to PE ratios, you can see big differences in many other metrics, like the PB ratio or the price to book ratio, return on equity, return on capital employed, free cash flow, etc. All this is pointing to the fact that the HDFC Top 100 fund management team practices a very different style of investing. Now, the reason why we have been stressing so much on this is not to establish that comparing the HDFC Top 100 with another large cap fund is useless, or maybe that's because they are apples and oranges. That's not the point. The point is that, and we should understand this really well, when you buy units into a mutual fund, you're not really buying performance because it's impossible to predict what's going to happen in the future to any certainty. So when you buy into any mutual fund, what you are really doing is buying into the investing style of the fund manager. I don't know if you've really thought about mutual fund investing in this way, but take a minute, pause this video and think through it. And while you're at it, do make sure you click on that subscribe button and tap the bell icon for notification alerts. Okay, so we are ascribing to a fund manager's investing style when buying a mutual fund. The HDFC Top 100 Fund is managed by someone who needs no introduction in the mutual fund circles. Prashant Jain is the Chief Investment Officer at HDFC Asset Management Company and has been managing this very fund for a little over 17 years. He also manages the HDFC Equity Fund and the HDFC Balanced Advantage Fund. Now, people like me who have been invested in a Prashant Jain managed fund for many years now have come to recognize his pattern of investing. Mr. Jain leans on a value investing style, which in simple terms means buying businesses that have done well, but their stock prices have not kept pace. In other words, businesses which are available at a bargain or at a discount. And it is this system of finding undervalued companies that has been very profitable over the years for investors in this fund. Now, let me be honest here. The system is not perfect, but then there is no perfect system in investing. There will be ups and there will be downs. And since a number of questions have been asked on the last 2 years of poor performance of this fund, we'll try to answer some of those here. Let's turn our attention to how the HDFC Top 100 Fund has invested money across sectors in the last 8 years. Okay, that's a lot of numbers, but I want to discuss only 2 major sectors here, as they are the ones which have had a big bearing on the below average performance of the HDFC Top 100 funds over the last 2 years. The first one, let's look at banking and finance. The allocation of banking and NBFC stocks in this fund has been in the low and mid 30% for a few years now, which is fine and generally the case with most large cap funds. But one of the major laggards of this fund has been the State Bank of India, which comprises around 6% of the assets. This SBI allocation has had an adverse effect on the portfolio performance. The second area which did not work very well for the management team was the investments in utilities. Utilities generally refers to areas like power generation, refineries, mining, infrastructure finance, etc. Starting 2018, the fund manager started to allocate more assets toward utilities by lapping up shares in Coal India, NTPC, that's the National Thermal Power Corporation, Power Grid, BPCL, Rural Electrification Corporation, etc. Unfortunately, the investments in these companies have led to a lot of pain in terms of the fund's performance. In the last 2 years, the Nifty Energy Index delivered negative 6% and negative 1%. But Nifty Energy includes Reliance Industries, which for all practical purposes is not really an energy company. Now, if we remove Reliance Industries, the average performance of the energy sector goes down even further from negative 1% to negative 30% in the last 1 year. And this has been a big drag on HDFC Top 100's performance. So there you go. The top 2 reasons for a below par performance for HDFC Top 100 Fund has been 1, the State Bank of India stock, and second, the energy stocks. Now, Prashant Jain is an experienced and calculative fund manager who has delivered superlative returns over many years. In fact, since taking over the reins of the HDFC Top 100 Fund in June 2003, the fund has delivered an annualized return of 18%. There's a lot we can learn from his investing style, and in this section, we'll try to understand why he invested a plenty in State Bank of India and in the utility stocks. Let's start with the fund's investment in SBI. The September 2020 fact sheet shows that over 5% of the scheme's assets are invested in SBI. In comparison, most other large cap schemes have little or no exposure to SBI. So what might have been the rationale behind having SBI in the portfolio? We think this is a classical sum of the parts situation. A sum of the parts approach is one where a holding company has a stake in many other companies, which, when all put together, adds up to a much bigger valuation. Think of it like a Matirosh ka doll. Okay, so there is a holding company, and within the holding company are a number of subsidiary companies, each of which have their own value. And when you actually add together the value of each of these subsidiary companies, what you get is not just the holding company's valuation, but a valuation of all these companies, which together become the sum of the parts. So in case of SBI, you must be wondering, what are these other companies? Let's have a look at the subsidiaries and companies where SBI has a stake in. Now, SBI has a 57% stake in SBI Life Insurance, which is a listed company with a market capitalization of 78,000 crores. 57% of 78,000 crores comes to almost 45,000 crores. This means the State Bank of India, which has a 1,75,000 crore market capitalization, has another company inside it which is worth 45,000 crores or 25% of the SBI's market cap. Now that's big. But that's not all. SBI also has a 69% stake in SBI Cards and Payment Services Limited, which is another listed company. This comes to an even bigger piece of the pie for SBI with a valuation of 55,000 crores. So these two companies together carry 1 lakh crores of value for SBI out of SBI's market capitalization of 1,75,000 crores. But that's not all. There are even more companies. SBI has a 70% stake in SBI General Insurance. There is another 100% stake in SBI Capital Markets Limited. SBI also has a 63% stake in SBI Asset Management Company. SBI also holds minor stakes in National Stock Exchange, and a small stake in UTI Asset Management Company, which just got listed in the Indian stock exchanges. While we haven't done any valuation of SBI, there are reports floating around that the value of these subsidiaries can be as large as the bank itself, which means an investor in SBI can virtually get the banking business of SBI absolutely free of cost. Let me say that again. Per the sum of parts approach, the banking business of India's largest bank with over 40 crore account holders is mathematically available free of cost. That's a business which serves up 14,400 crores of net profits in the last financial year, which is $2 billion of net profit, and it's available at $0. It's quite a statement, isn't it? And we suspect that's what is happening here and why the HDFC fund management team might have put their bets on the State Bank of India. Eventually, SBI is likely to unlock the value of all its subsidiaries, and the HDFC team is looking forward for a payday or a reward for their patience. This is a classical form of value investing. Excluding SBI, the HDFC Top 100 Fund has a bunch of public sector enterprises in the utilities, refinery, mining, and financing sector. These have been a massive liability on the fund's performance for the past 1 year. So why is Prashant Jain and team holding on to these? We suspect this is to do with two variables. Number one, the fund management team feels that the utilities are undervalued. Now, why is that the case? Let's consider the PB ratio or the price to book ratio of these companies. Currently, we see that a number of these companies are operating at a PB ratio of less than 1, which is an indicator of undervaluation. Now, I am no fund manager, but this would certainly keep me excited. But our research team suspects there's a second reason why we think HDFC Top 100 likes these public sector enterprises, and that has to do with the dividend yield commanded by these companies. To give a perspective here, the benchmark 10-year India bond yields are currently yielding at around 6%. Let's compare this 6% with the dividend yield of our 7 PSUs in the HDFC Top 100 Fund. We see that all 7 companies are offering a dividend yield of at least 4%, which itself is a great incentive to consider them in an environment where the Nifty 500 dividend yield itself is less than 1.5%. Now, of the 7 companies, notice that the REC, Coal India, and Power Finance Corporation are offering upwards of 10% dividend yield. And this is again something from the value investing playbook, because for all practical purposes, Prashant Jain and team is considering these 3 companies not as stocks, but they're actually considering them as bonds. Just think about it. Why would I want to put my money on a 6% bond when I can make more than 10% in a stock, which looks like a stock but actually behaves like a bond? In fact, in addition to receiving 10% from this stock, there is another margin of safety that is built in because of the prevailing low interest rate environment. So what happens here is that when interest rates are low, the demand for high dividend yielding stocks actually increases. And we all know what happens when demand increases. Yes, you're right, the price also increases. That is what we think the fund management team is doing here with utility stocks. They're making a play for buying undervalued companies with high dividend yields in a low interest rate environment. Well, it's like football. If you have been following a football club for a few years, I'm quite certain you not only know the players but are likely to know which formation suits your team, and that's exactly our point here. When you're buying into a fund, you're trusting the fund manager's formation of companies and his or her style of play. And in the first section of this video, we did discuss 2 styles of play. A, the growth approach, which AXIS seems to be in favor of, and B, the value approach, of which Prashant Jain and his team are big proponents of. With regards to the underperformance of HDFC's equity mutual funds, we all are now more aware of what has happened in the past 2 years and what was the fund manager's motivation behind having these companies in the first place. This is the kind of knowledge that will make all of us better investors. I certainly hope you liked this ETMONEY Insights episode as much as I loved presenting it. Do type in your questions in the comment box below, and don't forget to like, subscribe and share this video with your friends and colleagues. Thank you for watching, and we'll be back next week with another insightful video.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.